Hello, dear students. Let's start our class for accounting honors third year. Our subject is financial management. Uh, Name of the chapter is financial management. Chapter name: capital budgeting and risk analysis. Uh, okay, let's start. Sensitivity analysis. According to Investopedia, sensitivity analysis is very useful when attempting to determine the impact the actual outcome of a particular variable will have it if it differs from what was previously assumed. By creating a given set of scenarios, the analyst can determine how changes in one variable will impact the target variable. Next, scenario analysis. What is scenario analysis? Scenario analysis is the process of estimating the expected value of a portfolio after a given period of time, assuming specific changes in the values of the portfolio's securities or key factors take place, such as the changes in the interest rate. Scenario analysis is a process of analyzing future events by considering alternative possible outcomes, sometimes called alternative worlds. Thus, scenario analysis, which is one of the main forms of projection, does not try to show an exact picture of the future. Instead, it presents several alternative future developments. Consequently, a scope of possible future outcome is observable. Not only are the outcomes observable, also the development paths leading to the outcomes. You can see in the contrast progress, uh, past term exploration or the past of the extension of past trends. It does not rely on historical data and does not expect past observations to remain valid in the future. Instead, it tries to consider possible developments and turning points, which may only be connected to the past. In short, several scenarios are fleshed out in a scenario analysis to show possible future outcomes. Each scenario normally combines optimistic, pessimistic, and more and less probable developments. However, all aspects of scenarios should be plausible. Although highly discussed, experience has shown that around three scenarios are most appropriate for further discussion and selection. More scenarios risk making the analysis overly complicated. Scenarios are often confused with other tools and approaches to planning. The flowchart to the right provides a process for classifying a phenomenon as a scenario in the intuitive logics tradition. Okay, now we will discuss with an example. Here are some data are given below. NCO 200,000, project life 5 years, cost of equity KE 12%, depreciation straight line method. Tax rate 34%. Here are three conditions: base, worst, and best condition. Three situation. Variables are sales unit. We can see 6,000, 5,500, and 6,500. Selling price per unit taka 80, 75, and 85. Here per units it will be variable cost. Sorry, you can't see. It will be variable cost per units taka 60, 62, and 58. Fixed cost for the base condition situation taka 50,000, worst condition taka 55,000, and in the best condition 45,000. Now we have to determine the NPV, net present value, base, worst, and this best situation. You can see this scenario. Here are the three scenario: base, worst, and best condition. And you can see sales. Here is shown sales unit, selling price, country, variable cost per unit, fixed cost, total fixed cost. How to calculate the NPV? First of all, we need to calculate the CFAT. Then we can calculate NPV. So the here NCO. Then we need to calculate depreciation, and then CFAT. So now we can forward for annual depreciation. What will be the depreciation? We know the formula. Depreciation of formula of depreciation: cost minus salvage value, project life. There are no salvage value. Cost of the project 200,000 minus salvage value 0, project life 5 years. So yearly annual depreciation is 40,000. Now we need to calculate the PVIFA. PVIFA. PVIFA, we know the formula: 1 divided by R. You can see this formula. Probably you know the formula, and you can write this formula in the other way, but I think this shape is suitable for students. We know the rate of interest cost of equity is 12%. 1 by R, rate of interest 0.12. 1 minus 1 divided by 1 plus R, 1 plus 0.12. Number of years, number of period equal to 5 years. So n equal to 5. You can calculate in your calculator. 1 divided by 0.12, second bracket, 1 minus 1 by 1.12 power 5. Then use a bracket here if you wish. 1 divided by 2 and the calculation. So here the calculated result is 3.6048. Now we will calculate CFAT. The variables: sales unit, you already seen the selling unit 6,000 unit in the best condition, worst condition 5,500 unit, in the best condition 6,500 units. Selling price per unit you show 80, 75, 85 only. So sales was 480,000, 412,000, 552,500. Plus variable cost. Variable cost you have to multiply the unit selling price per unit into variable cost per unit. 360, 360,000, 341,000, 377,000. We know the contribution sales minus variable cost equal to contribution. So here contribution is uh, sales minus variable cost equal to contribution. Here's the contribution less fixed cost 50,000, 55,000, 45,000. EBIT less depreciation, um, as depreciation was not included in the fixed cost, so the depreciation we have to deduct 40,000, and EBT earning before tax 30,000 minus 23,500, 90,500 less tax rate at the rate of 34%. EAT EBIT minus tax EAT earning after tax. For calculate CFAT we have to add depreciation 40,000. So here is the CFAT for three condition: base, worst, and best condition. Now we will calculate NPV. You know how to calculate NPV. NPV equal to CFAT into PVIFA minus PV of NCO. We know that CFAT for base condition 59,800, PVIFA same 3.0648, and NCO for all the situation 200,000. Here is the calculation, and the result is Taka 15,567. Next, for worst situation, NPV worst 24,490 into 3.0648 minus NCO. Here CFAT you can see 24,490, PVIFA 3.0648, PV of NCO 200,000. NV goes to what? It is a minus figure, minus 111,719. Best. What is the NPV in best situation? CFAT 99,730, PVIFA 3.0648, PV of NCO net cash outlay or investment 200,000. So NPV in best condition 105,652. Now, what is standard deviation method? Standard deviation is an absolute measure which can be applied when the projects involve the same outlay in statistical terms. Standard deviation is defined as the square root of the mean of squared deviations, where deviation is the difference between an outcome and the expected mean value of all outcomes. The projects having a higher standard deviation is said to be more risky as compared to the other. So it's a comparable data. Standard deviation is statistical technique used in capital budgeting decisions to determine the variation or deviation from the mean of cash flows of the project. The capital investment decision will be taken keeping in view the variation in the expected value, where two projects have the same expected value. Now we will discuss with an example. A company is considering taking up on two projects, X and Y. Both projects have the same life, require equal investments of Taka 80,000 each, and both are estimated to have almost the same yield. As the company is new to this type of business, the cash flows arising from the projects cannot be estimated with certainty. An attempt was therefore made to use probability to analyze the pattern of cash flows from either projects during the first year of operation. This pattern is likely to continue during the life of these projects. The results of this analysis are as follows. Now, I can say there are two same type of projects X and Y, and both projects uh, require equal investments of taka 80,000. And here is the some data for project X and project Y. Cash flows 12,000, 14,000, 16,000, 18,000, and 20,000. The probability of cash flows 0.10, 0.2, 0.40, 0.20, zero point 0.1. Probability, total probability equal to 1. For project Y, cash flows 8,000, 12,000, 16,000, 20,000, and 24,000. Probability 0.10, 0.25, 0.30, 0.25, 0.10. And this total probability will be 1. Cash flows for project X, cash flows for project Y. Now, requirements, expected cash flows, variance, and standard deviation. So, one, how to calculate the cash flows, expected cash flows, or cash flows into probability. We have to multiply cash flows into probability, and then we have to summarize for all the cash flows. First for project X, for there was 12,000 and probability was 0.101, 14,000 probability 0.2, 16,000 probability was 0.4, 18,000 probability was 0.2, plus 20,000 probability 0.1. So total we have to multiply and add all of the amounts, that is 15,000 and 200. In the same way, we have to calculate project cash flows for project Y. Now we will discuss to calculate variance and the standard deviation. And here is the table for the calculation. Cash flows 12, 14, 16, 18, 20, and total cash flow is 80. We can check it. The probability was, now we have to multiply, and 12,000 into 0.1, here is the result, 12,000, 14,000, 0.2, 16,000, 0.4, 18,000, 0.2, 20,000, 0.1. Here is the result. And now what is the mean of this? 16,000 divided by 1, 2, 3, 4, 5. So we can calculate, and 80,000 divided by 5 equal to 60,000. 16,000. 80,000 total cash flow 80,000, and average or mean cash flows is 16,000. So now x minus x bar, x and x 12,000 and x bar that is 16,000. So minus 4,000. 14,000 minus 16,000 equal to minus 2,000. 16,000 minus 16,000 equal to 0. We know here x bar or mean equal to, as the mean equal to 16,000, and 18,000 minus 16,000 equal to 2,000. 20,000 minus 16,000 equal to 4,000. So here x minus x bar squaring this amount, 4,000 square here, 2,000 square here, 0 square here, 2,000 here, 4,000 here. In the last column, we have to multiply the with probability. So here this column, you have to multiply this column with this column, and here is the result: 0.2 to 40 lakh or 4 million into 0.2, 800,000, and here 0.1 into 16 million. So uh, 1 million and 600,000. Summation of this amount is 480, and uh, this is um, the variance, and we know standard deviation equal to square root of variance. So standard deviation of project A equal to, here's the result, and it's a root, square root. Result is near about approximately 2190. In the same way, we will calculate for the project Y expected cash flows. Uh, we know the project's cash flows, estimated cash flows was 8,000, 12,000, 16,000, 20,000, and 24,000. And here these are the probabilities, and the result is 16,000 also. And in the same way, you can calculate we can calculate the variance, and here's the variance. um, we can get this column by multiplying this column into this column, and um, you know the average cash flows or mean cash flows are 16,000. So in the previous uh, page we see how to calculate, how the calculation is made, and in the same way we have got this amount, and this is the standard deviation variance, and variance and standard deviation of project, sorry, not it's will be not it's only project A, that's will be X and Y, and this the name standard deviation project Y equal to 4,560. So we analyze scenario analysis, and then we discuss with an example. I think if you need, you can calculate the result. So thanks to the viewers. Today we will discuss with a few uh, university questions, and we will close this chapter: capital budgeting and risk analysis. You can subscribe my channel, and you can comment with, then it will be easy for me to discuss.